The essential tools. Most people think analyzing stocks requires a finance degree. They're wrong. In the next 15 minutes, you'll learn a 4-step system that takes less than 5 minutes per stock. By the end of this video, you'll know exactly whether any company is worth your money or not. Let's get started. Yahoo Finance is free and doesn't require you to hand over your email address to 17 different newsletters. Go to finance.yahoo.com and you'll see a search bar at the top. Type either the company name or its ticker symbol. A ticker symbol is Wall Street's way of giving companies nickname badges. Apple is AAPL. Coca-Cola is KO. Tesla is TSLA. Think of it like airport codes. Nobody says Los Angeles International Airport when LAX does the job. Click the matching result and you land on the stock profile page. You'll see 3 sections: current stock price at the top, a chart in the middle showing price movement, and financial statistics below. These 3 sections are your entire toolkit. Everything else on the internet is just these same numbers dressed up in fancier clothes. The chart defaults to 1 day, which is about as useful as checking your weight every hour. Click 1Y for the 1-year view. This shows 12 months of price history. The line going up means the stock gained value. The line going down means it lost value. The line going sideways means the stock spent a year accomplishing nothing. Kind of like most people's gym memberships. Hover your cursor over any point to see the exact price and date. Look for big spikes or sudden drops. These are the plot twists. A massive spike usually means the company announced something investors loved. A new product, better than expected earnings, or news that their competitor just face-planted. A sudden drop means something spooked investors. Bad earnings, a lawsuit, or the CEO tweeting something questionable at 2 a.m. The 1-year chart tells you if this stock is currently on a hot streak, in a slump, or stuck in neutral. Click 5Y for the 5-year view. This is where you separate the real companies from the hype machines. Over 5 years, temporary drama fades, and the actual business performance shows through. If the line generally climbs from bottom left to top right, even with some dips along the way, you're looking at a company that consistently creates value. If the line looks like a heartbeat monitor during a horror movie, constant drops with no recovery, that's a company slowly dying. Pay attention to how the stock handles bad times. Does it drop and then bounce back? That's resilience. Does it drop and keep dropping? That's a sinking ship. The 5-year chart is like checking someone's dating history. Sure, everyone has some rough patches, but if it's all rough patches, maybe swipe left. The 4 numbers that matter. Market capitalization is calculated by multiplying the stock price by total shares outstanding. It tells you the company's total value. Think of it like this. If you wanted to buy the entire company outright, market cap is roughly what you'd need to pay. Large cap companies are above $10 billion. These are the established giants. Apple, Microsoft, Walmart, they're like cruise ships. Slow to turn, hard to sink, not particularly exciting, but they'll probably get you where you're going. Mid-cap companies sit between $2 and $10 billion. These are growing businesses that have proven themselves but still have room to expand. They're like sports cars, faster than cruise ships, but also more likely to break down if something goes wrong. Small-cap companies are under $2 billion. These are the startups and niche players with huge potential or huge risk. Sometimes both. They're like motorcycles, thrilling, but you really need to know what you're doing. For beginners, stick with large caps above $10 billion. You can get adventurous after you've learned not to panic sell every time the market has a bad day. The price-to-earnings ratio compares the stock price to the company's earnings per share. Earnings per share is the company's profit divided by number of shares. The P/E ratio is then the stock price divided by earnings per share. Here's the analogy that actually makes sense. Imagine you're buying a rental property. The P/E ratio is like comparing the purchase price to the annual rent you'll collect. If a house costs $300,000 and generates $15,000 per year in rent, that's a P/E of 20. You're paying 20 times the annual income. A P/E below 15 means you're getting earnings cheap. The stock might be undervalued, or everyone thinks the company is about to have a terrible year. A P/E between 15 and 25 is normal for solid companies. You're paying a fair price for reliable earnings. A P/E above 25 means investors expect big growth. This is common for tech companies where people believe earnings will explode in the future. It's also common for overhyped stocks where people have lost their minds. The trick is comparing P/E ratios within the same industry. A P/E of 30 might be insane for a grocery store chain, but totally normal for a software company. Grocery stores grow slowly and predictably. Software companies can double in size if they build the right product. Don't compare apples to oranges. Or more accurately, don't compare apples to Orange Julius franchises. Dividend yield shows how much cash the company pays you annually as a percentage of the stock price. If you own a $100 stock that pays $3 per year in dividends, that's a 3% yield. Dividends are like rent payments from the company. You own a piece of the business, and the business shares profits with you. Not all companies pay dividends. Fast-growing companies usually reinvest all profits back into expansion rather than handing out cash. Mature companies with stable cash flow, think utilities, consumer goods, and banks, tend to pay regular dividends. They've stopped growing rapidly, so they reward shareholders with steady payments instead. Dividend yield serves two purposes. First, it's passive income. Money hits your account just for holding shares. Second, consistent dividends signal financial health. Companies that pay and increase dividends year after year are basically saying, we're so confident in our cash flow that we're committing to pay you regardless of market conditions. Companies that cut dividends are waving a red flag that says, we're running low on cash and things might get ugly. For beginners, dividend-paying stocks are psychologically easier to hold. Even if the stock price goes nowhere for a year, you still collected 3 or 4% in dividends. It takes the edge off the anxiety. Let's take a quick pause. If this breakdown is making stock analysis feel less intimidating, hit the like button. It helps this video reach more people who are trying to learn investing without the confusing jargon. All right, let's keep going. The decision framework. The 52-week range shows the highest and lowest price over the past year. If the current price is near the bottom of that range, the stock might be on sale. Maybe the company had one bad quarter and investors overreacted. Maybe the whole market is down and dragging everything with it. If fundamentals are solid, buying near the low can be smart. If the current price is near the top of the range, you might be buying at peak optimism. Everyone already loves this stock, which means future gains require even more people to get excited. Not impossible, but you're paying full price with no discount. The 52-week range is like checking the price history before buying anything expensive. You wouldn't buy a TV for $800 if it was $700 last month, unless something changed to justify the jump. Same logic applies to stocks. Use this with the other metrics. A stock near its 52-week low with terrible fundamentals is cheap for a reason. A stock near its 52-week high with strong growth might keep climbing. Context matters. Before buying any stock, run through these 4 checks. First, look at the 5-year chart. Does it trend upward with recoveries after dips? You want companies that grow over time and bounce back from setbacks. If the 5-year chart looks like someone threw it down a staircase, skip it. Second, confirm market cap is above $10 billion. This keeps you in the stable, established company zone while you're learning. You can get fancy with small caps later after you've made and lost some money and know what you're doing. Third, check the PE ratio falls between 15 and 25. This is the Goldilocks zone. Not so low that something's wrong, not so high that you're paying for fantasies. A PE slightly outside this range is fine if other factors are strong. A PE of 50 requires investigation. Fourth, see if the company pays dividends. This is optional but valuable. Consistent dividends mean reliable cash flow and give you income while you wait for the stock to appreciate. If a stock meets 3 out of 4 criteria, it's probably reasonable for beginners. If it meets all 4, you've found a solid candidate. If it only meets 1 or 2, you're gambling rather than investing. Search AAPL on Yahoo Finance. Switch to the 1-year chart. You'll see fluctuations but an overall upward trend. Apple had a good year. Switch to the 5-year chart. Consistent growth from bottom left to top right with recoveries after every dip. This is what long-term value creation looks like. Check the market cap. Apple is over $2 trillion. This is as established as it gets. The company could accidentally delete half its products and still be worth more than most countries. Check the PE ratio, usually around 25 to 30, slightly above the ideal range, which means investors are paying a premium for Apple's brand strength and ecosystem. Not a deal, but not absurd. Check the dividend. Apple pays around 0.5% yield. Not huge, but the company has increased it consistently for over a decade. That's commitment to shareholders. Check the 52-week range to see if you're buying at a discount or at peak price. If you're in the middle of the range, that's reasonable. If you're at the all-time high, maybe wait for a dip, unless you're investing for 10 years and don't care about short-term price. Apple checks all 4 boxes. Strong 5-year growth, massive market cap, reasonable PE for its quality, consistent consistent dividends. This is why Apple shows up in every beginner portfolio guide. It's not exciting, but it's reliable. Some stocks wave red flags so aggressively, they might as well be bullfighters. First, erratic long-term charts with constant drops and no recovery. All stocks dip occasionally. Healthy stocks recover. Stocks that crater repeatedly without bouncing back are dying slowly. Second, P/E ratios above 40 suggest the stock price has left reality behind. Unless the company is genuinely about to revolutionize an industry, these valuations are built on hope and hype. When reality disappoints, the price collapses. Third, declining market cap over multiple years. The company's total value is shrinking because either the stock price keeps falling or they're burning through cash. Neither is good. Fourth, dividend cuts. When a company reduces or eliminates dividends, it's admitting cash flow problems. This often precedes worse news. Fifth, stocks at 52-week highs with no clear reason. If the price just spiked 20% but earnings didn't improve and no major news dropped, that's speculation, not investing. Speculation eventually ends badly for whoever bought at the peak. If you spot 2 or more of these red flags, walk away. There are thousands of stocks. You don't need to gamble on the sketchy ones. Practice before you invest. Create a watch list of stocks you're interested in but not ready to buy yet. On Yahoo Finance, click Add to Watch List on any stock page. Organize by category: technology, consumer goods, healthcare, finance. Add 5 to 10 stocks initially. Check your watch list weekly. Note which stocks hit new highs, which drop to new lows, and which barely move. Watch for patterns. Do tech stocks all move together? Do certain stocks jump after earnings reports? This observation period trains your instincts. You'll start recognizing what normal volatility looks like versus actual problems. A watch list also prevents impulsive decisions. Instead of seeing a headline about a hot stock and buying immediately, you can add it to your watch list, observe for a few weeks, and make a rational decision based on data rather than hype. Think of it like dating. You don't propose on the first date. You observe, evaluate, and make decisions when you actually understand what you're getting into. Paper trading uses virtual money to simulate real investing without actual risk. Yahoo Finance, Investopedia, and Webull all offer free paper trading. You get a fake account with $100,000 and can buy and sell stocks at real market prices. Use the same analysis process. Find stocks that meet your checklist criteria, buy shares with your virtual money, and track performance. Paper trading teaches you 3 critical things. First, the mechanics of placing orders and managing a portfolio. Second, whether your stock selection actually works. You might think you're finding great companies only to discover your virtual portfolio loses money consistently. Better to learn that with fake money than real savings. Third, emotional control. Even with virtual money, watching positions drop 10 or 20% triggers anxiety. This prepares you for real investing where actual money is at stake. Paper trade for at least 3 months. Experience different market conditions: up weeks, down weeks, sideways weeks. If you consistently make good decisions with virtual money, you're ready to start with real money. Start small, $50 to $100 per trade, and gradually increase as confidence grows. The goal isn't to get rich quick. The goal is to build skills that compound over time, just like the returns you're aiming for. You now have a complete system to analyze any stock in under 5 minutes. If you want more step-by-step investing tutorials like this, subscribe to the channel. Next video, we'll cover how to build a diversified portfolio, or you can watch how to find undervalued stocks before everyone else does. Thanks for watching.